of a focus point for these types of portfolios and investments?
So like I said, it's really about a framework. So if you look at behavior, as humans, we know we are emotional creatures.
We've got discretionary investing, we've got now systematic investing, we've got passive investing. What are the differences between those?
So let's maybe start with passive investing. Let's take passive as very much tracking an index. It's not a type of investing where you're trying to get active returns.
And it's because I heard you deliver such a fantastic presentation at one of the conferences I was at. And this was on AI and using AI and agentic AI in portfolio construction. Where does AI fit into this conversation?
We see AI as a very helpful set of tools at the moment. Typically these are not black box approaches, and that's what I want to be very clear about. AI can be used to make the research process much more faster and efficient, for example.
Hi, everybody, and welcome back to EBnet Stream for today's episode of Industry Insights. I'm joined by Chetan Ramlall, who is a portfolio manager at STANLIB, to have a conversation around a phrase that seems to be becoming more and more common in our investment language, and that is systematic investing. So before we get there, let's welcome Chetan to the show.
Hi, Natalie. Thank you so much for having me. Really happy to be here.
You're welcome. So as I mentioned in my intro, systematic investing is something that I'm reading more and more about across a number of platforms, and we ourselves have published some of your content on that, and very recently an article of yours. What is systematic investing?
So such an excellent place to start, Natalie. Ultimately, systematic investing is about a framework. It's about having a solid decision-making process when making investment decisions. That's really what it is at its heart. There's an excellent quote where Warren Buffett speaks about, to invest successfully over the long term, what's really needed is a sound intellectual framework for making decisions, and then the ability to stop emotions from corroding that framework. And that very nicely encapsulates how systematic investing comes into play, where it can create this framework and really remove these sort of behavioral biases and risks to the process.
So we have published a lot recently on behavioral, I'm going to call it behavioral finance, but the impacts of behavior and the way that it, I want to say, erodes wealth or erodes value. Is the kind of dealing with this behavior one of the upsides or one of the main advantages of systematic investing, or is there something that's more important or more of a focus point for these types of portfolios and investments?
So like I said, it's really about a framework. So if you look at behavior, as humans, we know we are emotional creatures. And oftentimes it's very easy to be swayed by our emotions when making big decisions. And that can be a double-edged sword. And often we believe that over the long term, that can be a risk to the portfolio construction process and to the investment process. Hence, systematic investing has really come to the fore as a way to consistently and repeatably build processes and structures to make these decisions. Yes, there are times maybe where some nuance comes into play, but sometimes that's not always the case. And it's very hard to consistently and repeatably make these decisions. And those are really the key words that do come up.
I think as you're chatting, I'm thinking about systematic, this process and this framework, and I'm trying to put it in the library or the contents page of an institutional investor's playbook. And so we've got discretionary investing, we've got now systematic investing, we've got passive investing. What are the differences between those?
So let's maybe start with passive investing. Let's take passive as very much tracking an index. It's not a type of investing where you're trying to get active returns. You are trying to simply follow the market. So that's where the word passive comes from. And that could be tracking an equity index, a bond index, etc. Okay, so that's where we talk about getting market exposure, where you get the technical term is beta. You get a beta exposure to the market, but that's all you want. You just want to be participating. Then you move into the other side of the equation, which is active investing. And there we can broadly speak about the discretionary side and the systematic side. Ultimately, active investing is about finding returns above the market, ideally. So that's where the term active comes from. Now, this can be done in a discretionary way, which we'll be speaking about, or a systematic way. And ultimately, those two phrases and those two terms, it's about how do you make decisions? They're not, in fact, different. It's just at the heart, how the problem is solved and how the problem is approached is slightly different. But at its heart, it's still active management, very much active management, and it's trying to beat a benchmark.
What is the difference between a systematically approached investment and an investment strategy or mandate that a trustee board or an institutional client may give STANLIB, for example?
Mhm. So once again, we are in the realm of active investing. The word I've often used thus far is framework. So in the systematic realm, it's much more about building a repeatable and consistent investment process that looks at things like your stock selection, your portfolio construction, your risk management, but in a much more rules-based, evidence-based approach. So there's not a lot of discretion, not a lot of bias that comes into play, which as we've been discussing, is a very big risk over the long term. So the way to think about a systematic active equity manager is simply a manager that has designed a process up front where a lot of that judgment is taken at the design step and the design phase of the process by looking at a lot of research, looking at how investment signals are calibrated and measured, looking at how risk management is constructed, looking at how portfolio construction is done, but in an evidence-based and a consistent manner. So that word of repeatability and consistency is very crucial. On the discretionary side, it's different, where that's sort of judgment in the moment, where it's not sort of upfront process design, but rather making decisions in the moment, obviously with analysis behind it. But on the systematic world, it's sort of judgment upfront, where you build a process. And that term of process is the key difference between the two.
Oh, I nearly went down to performance, but we'll go there just now. I think I want to say, and maybe correct me if this is wrong, but a systematic investment approach is almost designing right up front what the portfolio says on the tin. It tells the consumer, the ultimate investor, this is what I'm selling you, this is what you're investing in, and right up front the let's call them the rules of the game.
That's exactly it. If you look at the markets, by their nature, there's so much noise and there's so much uncertainty, as we know, as we see what's playing out in the current news cycle. And cutting out that noise, and a term we often use is separating signal from noise. How do you disentangle what is real and what is speculation and what is noise? This is sort of the realm where systematic strategies come into play, where it's trying to really identify what is useful and what is not. So over the long term, we find that by taking that approach, that's really where you will hope to get better outcomes and more consistent outcomes. So to your question, ultimately, it's about having this framework that can be measured and in some sense almost be a very transparent look at the mind of a manager. Because every position, every sort of exposure in the portfolio, there's a very, very defined set of rules behind it. There's evidence to why a certain position is taken, why a certain sector position is taken, for example. So every part of the process can be deconstructed. And I must categorically say that, and most systematic type processes are not black box approaches. It's very much approaches that can be understood and deconstructed to understand why positions are taken. And that's a very key point to make.
I wanted to use this word deconstructed because I think that's an important differentiator here, is the ability to deconstruct or have a window into the portfolio manager's mind. Now, you're a portfolio manager, right? And so, I mean, I'd like to think that by virtue of your role, you bring value to the table and you give your flair or your expertise to the portfolios that you manage. Is systematic investing then not prescriptive, or does it not stymie your creativity?
Oh, not at all, Natalie. So I must be very clear that the process starts and ends with people, right? It's us as humans who are behind the construction of this process. And that's the key term. It's about building a process. A process has many steps. So along the way, we are intimately involved with the research, the building out of these different steps. So practically things like what fundamentals would we look at to look at companies and pick the best stocks? How do we measure and then manage risk? How do we quantify risk in the first place? How do we put all of these pieces together to actually build a portfolio? So if anything, as a portfolio manager, having a systematic process really helps us sleep at night to a large extent, because what it does is that it gives us a solid framework upon which we make decisions. I almost think of the example of a boy floating in the middle of the ocean. Sometimes when the waves start hitting and crashing, it just gets, thrown around, versus a ship with an anchor, where you've got an anchor point and a sort of foundation upon which you make decisions. And it's sort of that analogy which I find quite useful, where if anything, it helps us be more creative, but we're doing it through the lens of a framework. And it sort of links to my earlier point, where in a market and in a world that is so noisy, where there's so much uncertainty, where information moves so much faster than even 10 years ago or 20 years ago, now more than ever, we need a solid, repeatable framework. And that repeatability aspect is crucial.
And the risk mitigation opportunity presented by this recipe is certainly something that I don't think we should underplay. Because you rightly point out, it's noisy, it's volatile, it's deeply uncertain, and risk mitigation, I think, is going to become a big part of the conversation. And so as we mitigate this risk, and as we approach and apply these, I nearly wanted to say a formulaic approach, which this is not. I know that you'll take me out for saying something like that. But as we approach this kind of framework type of investing, is there an opportunity to say to a board of trustees, this makes your performance a lot more comparable with others, where others may be approaching this? Or is there a caution there for trustees to say to them, when looking at the performance, you need to understand that there is a systematic approach versus a more, let's call it, flamboyant, discretionary approach?
Yeah, so it's a very key point. And I think if you look at the sort of debate, the first thing to say is that it's not a binary debate by any means, sort of discretionary versus systematic. I wouldn't even think of it along those lines. The thing is, these are decision-making frameworks. That's ultimately the difference. Like I said, it's active management, but done slightly differently. So whether it's a board of trustees or, an asset allocator, of course, diversification is a massive talking point. So you want diversification in terms of returns, but another way to think of it is also diversification in decision-making, because it's a different process that comes to the table as well. And in different market environments and different regimes, different processes can work better. So it's that sort of way where it's not sort of this binary split. It's ultimately recognizing that in different phases, some approaches might be more applicable or more useful. And that's really it. So over the long term, yes, you can look at performance, but it's not as simple as looking at a top line number. It's about understanding, what is the market doing? Is the market in a phase where there's a lot of noise that's dominating? And perhaps the market is a bit disconnected from fundamentals. In that environment, perhaps a discretionary manager might have a bit of nuance and perhaps might add some qualitative flair that might be useful. But in the other breath, that can also lead to sort of style drift or inconsistency over the long term. Similarly, for a systematic process and a systematic manager, when the market gets disconnected from fundamentals and there's noise, sometimes it's difficult to capture that through rules. So a systematic manager might struggle. So it's almost just understanding that in different environments, you will get differing performance, but ultimately you want that diversification in a mix.
EBnet is proud to bring you top quality content from experts across the financial services industry in South Africa and internationally for free. Your support helps us in doing this. All we ask is that you subscribe to our channels by clicking the subscribe button below. Share this video with others you think will benefit from it, and give us thumbs up if you are enjoying the content. That way, you help us help you. Thank you from the team at EBnet. For more great content, please visit www.ebnet.co.za.
Let's talk about the fees before we talk about more interesting discussions around AI. But two questions come to mind. The first is that how would I know if my manager was a systematic manager? And if he or she said yes, is there a valid or reasonable expectation of a cheaper fee?
So remember, cheap does not mean sort of you're getting less. And I think that sort of idea of cheapness needs to be more framed around the term cost effective. Now, a systematic manager and a systematic process by its nature doesn't imply that fees will be lower, because oftentimes you might have a lot of sophisticated infrastructure, technology, research that goes into the background. However, the term that I'd use is cost effective, where by following this type of approach, it allows much more efficiency and a lot more scalability. And that's very crucial. So, for example, typically in a systematic process, you might be able to, instead of having a team of 20 analysts, you can achieve the outcomes you want with a much more streamlined team, because you are looking more at data, being more rules-based and evidence-based. So again, it's not as simple as sort of saying that being systematic will be lower fee, but it can generally be more cost effective. That also comes through in the way trades are done, where typically systematic type processes have very controlled turnover type dynamics. The way that they are rebalanced or traded can be done much more efficiently typically, which also sometimes has a benefit. So again, it's sort of a nuanced conversation. And to your point of how do you know if your manager is systematic or not, it's really when you sort of speak to a portfolio manager or analyst, when a manager speaks about having a framework or having rules that will determine your stock selection or risk management quantification, and then how is that put together in a portfolio construction process? Once the focus and the discussion is more on process and framework, that typically indicates a more systematic type approach. If the conversation is much more on individual stock stories and stock narratives and sort of judgment and meetings and sort of a bit more qualitative flair, that typically indicates discretionary. But like I said earlier, it's not a simple binary debate, and both have a place ultimately, but it's simply about understanding the difference in decision making.
I very much appreciate you saying that it's not binary, because I think we often get tempted to say it's this or this. And maybe this is just a version or a subset or a difference or a diversification technique. And the one thing I do want to get your opinion on, and it's because I heard you deliver such a fantastic presentation at one of the conferences I was at, and this was on AI and using AI and agentic AI in portfolio construction, and effectively talking yourself out of a job, really. But I wonder, as we're talking about frameworks, analysis of lots of data and deep and depth of data, where does AI fit into this conversation?
Yeah, of course, such a topical point. So I definitely don't think we'll be out of a job anytime soon. I must say, humans are, as I said earlier, intimately part of this process. We see AI as a very helpful set of tools at the moment. Typically these are not black box approaches, and that's what I want to be very clear about. AI can be used to make the research process much more faster and efficient, for example. It helps, for example, translating research into actual portfolio positions and insights. But it's not something that's being framed as almost being let loose on the market and trading. So that's not how we see it. we see AI as just sort of being value additive from a holistic perspective, but also understanding that one of the beauties of a systematic framework and a systematic approach is the word scalability. And I used that previously, where by the nature of the rules-based and evidence-based construction, more sophisticated technologies like AI and machine learning can be used to actually deliver portfolio insights. So you see, there's a difference. It's not as if some AI algorithm is running the model, but rather enhance and deliver insights to pieces of the process. So that's a very important distinction. So I think ultimately this entire AI debate is very powerful because it's definitely unlocking new avenues. And this becomes especially prevalent, Natalie, when you look at how much data there is in the world, right? The world at the moment is so data rich. There's far more complexity than, again, 10, 20 years ago. And the third piece, which I think doesn't get enough attention, is that data and information moves faster than ever. 20 years ago, 30 years ago, you might get a headline in the newspaper and the markets would react to that headline. Or there might be one TV program at 7 p.m. when you watch the news. Now, as we all know, you wake up in the morning and you're on your cell phone and you're seeing a tweet by Trump, or you're seeing something on social media, and the markets react to that. So that sort of delta in time has gone away, where information moves, it moves at more than light speed. And that means that the tools we use need to change, right? It's sort of intuitive that we can't be using the same frameworks and tools of 20 years ago to manage the markets and to manage money. Because the playing field has changed, intuitively, the tools need to also change with it. So that's really where the machine learning, the AI conversation really picks up. So it's about how can it actually augment and assist the investment process, assist portfolio managers, because ultimately we have the discretion and the judgment. But now we need to have better tools to help us make those decisions.
And better frameworks.
And better frameworks.
Repeatability, scalability, and really, like you say, this kind of clearer understanding of what it is we're trying to do here, because there is a lot of noise. Chetan, there's a lot of noise. I mean, I'm an investor, be it through a pension fund or with my own personal money, my discretionary savings. And you're 100% right. I pick up my phone in the morning, I look at the EBnet newsletter, I see what's happening with the markets, and I'm thinking, oh my word, I'm retiring in 15 years' time. I don't even know how to plan for that anymore, because the rules seem to be changing quicker than I can switch my investments. And I know I shouldn't switch because my behaviors, if anything's to go by, my behavior is going to be wrong. So in that context, you have to really feel for an institutional investor like a trustee, or an asset owner. And we don't get the opportunity every day to speak to a portfolio manager. So I'm going to put you on the spot maybe with this question. For any trustee listening out there, what is your one fundamental piece of advice as we are dealing with the noise and the volatility that has come with 2026?
So I think the first thing and most important thing is not to panic, and it's to understand that it's very clear what drives the investment markets and the financial markets over the long term. So it's understanding that there's a difference between noise and actual fundamental strength that pushes markets higher over the long term. We all understand what are good companies. We understand what are bad companies. And again, I'm speaking in the equity investing space in particular. We can have certainty in this because there's enough and there's mountains of data to back this up. So we need to take a step back and understand that panicking won't help. Understanding that there's a lot of noise in the system. So the logical next step is, how do you disentangle that noise from, and the term I used earlier was the signal. It all comes back to process. It comes back to framework. As I said, that takes a lot of pressure off, because ultimately when you make a decision, you want to know where that decision is coming from and what is it based upon. And it's very easy to get swept up in the tweet storm and in the noise storm, like you mentioned, And that's never going to lead to good outcomes because by nature, we are emotional, and emotions 9 times out of 10 or 10 times out of 10, when the pressure is on, will overcome and take over any sort of analysis or judgment. And ultimately, that is the biggest risk. So it's not to panic, but it's to look for processes, build frameworks in your own decision making, and then also make sure that your sort of supporters, your asset managers, whoever it is that you are working with in that sphere, also have a consistent process that's also not being changed on a whim. It's that sort of repeatability, that consistency that actually wins out over the long term. And I think it's really keeping that long-term view, ignoring the short-term froth that really will pay off over time.
It's interesting because as you were speaking there, I was thinking to myself, in this exceptionally unpredictable time, systematic investing almost introduces predictability, because instead of trying to control the outcomes, you're controlling the inputs or what goes into making the investment decision. And that, to a large degree, what you're saying is what will add alpha or value and better outcomes to our retirement fund investors, which is really what we're all trying to do here.
Yeah, that's exactly it, Natalie. Yeah.
Chetan, it's been wonderful catching up with you again and hearing your thoughts about systematic investing. Before we sign off, is there anything that perhaps I didn't ask or that you'd like to share further on this?
No, I think we've covered everything, Natalie. Yeah, thank you very much again. Really appreciate your time.
Lovely. Thanks so much, Chetan. Keep well.
Thanks, Natalie.